everybody. I hope you're doing well. Welcome to my office of the last few days. It's been absolutely insane, I'm sure, for all of you to get into the routine of working from home. Unless you already were in the routine of working from home, I can tell you that I absolutely hate working from home. I love seeing everyone's faces in the office, not only our staff, but also clients and friends and family. And so this has been a big adjustment for an extrovert to basically be by myself. So today's Thursday Thought, what we're going to do is we're going to run through just a variety of areas, a couple of housekeeping tips for the office real quickly for you, a few questions that we've been already getting over the last couple of weeks. Some of them may be a little bit dated, but I think at the same time they're timely. And then for those of you, like Katie mentioned, who think of a question during this or think of a follow-up question, feel free to either put it in the group chat or just email Katie directly at team@familyfinancialpartners.com, or you can email me directly at david.smyth with a Y, S-M-Y-T-H, at familyfinancialpartners.com. So to start off today, our office response to COVID-19 has been no different than most likely your experience in your particular field of work. We've had all of our employees working from home since around the middle of March. And as part of that, we all went into captivity with beards and things. And I even came out and I finally said, well, what's the point of wearing a beard if nobody can see it? So I know that sounds backwards. It's even more work to shave, but I've been feeling like I at least have a little bit of semblance of a normal work day, or just normal day in life by just getting up and at least shaving and showering every day. In addition, what we've been doing is we've been scheduling all meetings as conference calls. About 50% of our clients already do conference calls with us. So we do have clients in, I do not know the exact number, but it's 24, 25 states. So it's a big number. And so we do routinely do conference calls with you all. Now we've just moved everyone to conference calls. And if the virus persists, everyone's saying we're on lockdown at least through the start of May. Who knows how long it takes? I'm not going to even try to figure that one out. But if it does persist, we can continue to do these Zoom talks, or use WhatsApp if you don't have an Apple phone, or FaceTime for those of you with Apple phones, just to make sure that if you want to see our bright and smiley, cheery faces, you have the opportunity. When it comes to mail and paperwork, we have a strategy in place where we basically choose straws amongst the staff, and whoever gets the shortest straw has to go out and venture to the office. Now, we do have a system in place for one person to go and check the office mail, fumigate it and whatnot, open it, and then if there's anything timely, paperwork, anything that needs to be done, we send that paperwork to processing. Just keep in mind that we're still sending you paperwork for those of you. We've actually had a ton of people opening new accounts because they're just wanting to participate in the markets right now. There's just a number of just things that are going on, I think, that are just driving people to think, well, maybe this is a time to get involved. And we'll kind of discuss that a little later. But the point is, as documents and paperwork are coming in, we're sending them out electronically to you. We're using overnights, 2-day mail, whatever we need to do to get back those actual paper ink signatures. All checks that come in, keep in mind, we're seeing a number of checks and processing delays up at Pershing, which is our main custodian. And they've had delays as much as up to 72 hours plus. So with that said, one of the things that Greg Wright, our operations manager, has put in place is ways for you to do mobile deposits of checks. So if you are getting ready to drop a check in the mail to us, or just want to put some additional dollars in your account, feel free to give our office a call prior to dropping that in the mail, because there may be a way, depending on what account it's going into, that we can actually just do a mobile deposit for you and walk you through that. So the point is we're just trying to make sure that with the markets being as topsy-turvy as they are right now, that when you decide to send it in a check, it's not like it's 2 weeks until the check actually hits the account and is deposited. And I think that in all businesses and all banking, just check processing and paperwork has slowed down. That's probably the one negativity to all this from a business standpoint for us, is trying to figure our way around that, because our business is still one of the last industries where they don't want everything just to be electronic all the time. The reason a lot of people ask all the time, like, why? And well, the thing is, you know, you can sign up for a mortgage online. It's no big deal. You can get your car insurance online, but nobody wants to steal your car insurance information and make your car insurance payment for you. And nobody wants to steal your mortgage and make your mortgage payment for you. So when it comes to your investment accounts, they tend to be a little bit more protective of those accounts. And as Pershing is one of the largest custodians in the world, they tend to move like a battleship. And so they move very slow when they turn around. It's not like we're in a little skiff. So as things become more electronic, they will have that ability, but they're not quite there yet on everything as far as the paperwork. Now, taxes. Just a couple quick things there. By now, everybody knows, I'm sure, that your taxes are not due on April 15th. They're due not until July 15th. That said, you still have contribution deadlines that have also been extended for IRAs or Roth IRAs to July 15th. So if you've provided your taxes to your accountant and they come back and they say, hey, you can actually do an IRA or a Roth contribution this year because your income was, you know, different than what we were anticipating, where we didn't think you were gonna be able to do it, you can still write that check up to July 15th. So that's a nice one to kind of keep in mind. Also, many of you are, I know, filing early because we have all this free time at home. So I've talked to several of our CPAs out there, and believe it or not, they are also, many of them, working from home, and they are just as busy as they normally be in a regular tax season, if not more so, because so many people are trying to file early, especially those that by filing would be able to get that additional $1,200 check from the government. But for all of us that are not going to participate in that $1,200 check, no reason to overwhelm our CPAs right now. Let's just take some time, let them work through the system, and with filing extended until July 15th, I don't know about you, but I usually file an extension. And so usually my taxes aren't even done until closer to September, October. So this year will probably play out the same, no difference. But just kind of keep that in mind. From a tax document standpoint, all client tax docs, I've been assured by Greg, have been provided to you or to your tax professional, whichever way you've requested it. If for some reason you're still having questions coming back from your tax professional, please let our office know. Just give us a ring. Just say, hey, I've got a quick tax question or tax document question, and Katie will make sure to get you to our operations staff and they'll provide you with the correct information. Now, let's talk about some of the retirement account rule changes for 2020 that are going on. And a lot of people have been, let me move my little window there. A lot of people have been asking about, well, is there anything, in this new CARES Act that just went into effect a few weeks ago that I need to keep in mind? And number one thing is for anybody that has inherited any kind of IRA, just kind of keep in mind that you do not have to take any kind of distribution in 2020. It also applies to Roth IRAs. In addition, there we go. In addition, RMDs are suspended. So for a number of you clients that are out there that are taking retirement income, you've already perhaps taken the amount of your RMD out just in day-to-day paychecks, right? But for those of you that maybe have pensions or Social Security, things of that nature, and don't really need that IRA money and have just been flipping it from an IRA account into a non-qualified account and paying the federal tax as you go, you don't need to worry about that this year. So if you haven't done it, no need to worry about it. If you are of retirement age, again, don't need to worry about it. So we're getting a lot of questions of, well, I'm 70 or I'm 72. How does that impact me? This year, it doesn't impact you at all. You still don't have to take it. And whether it's a 401k account that you still have in an old employer, or you've rolled that into an IRA, no need to worry about that. And then lastly, there was a waiver of withdrawal penalties. So if you're in a situation where perhaps your income was greatly impacted over the last, month and change, 4 to 6 weeks, and or you think that it will continue to be impacted. Because a lot of people like have a little bit of emergency fund, right? And they have some savings and they can pay bills for a few months. But what happens if this thing continues all the way into fall and we all stay in our homes until fall? I hope that doesn't happen. But if it does, and you get to the point of like, I can't do my work and I'm self-employed, or my company has not just furloughed, they've fired me. What do I do then? Well, one of the things that this CARES Act allows for is you can take a distribution up to 100,000. You don't have to take all 100,000. You can take 5,000, 10,000, whatever you might need to do. But under this rule, you will not be hit with that 10% early withdrawal penalty that usually applies to anybody that's 59 and a half or younger, okay? Younger than 59 and a half. So the thought is, let's say I'm running short of my bills and I'm like, well, I don't know where else I'm going to get other money, but I have, my retirement account, my 401k or my IRA. I don't want to just take a loan. I actually want to just take a withdrawal. You could go in there, you could take $10,000 out. You would not pay a 10% penalty that you'd usually pay. But the one thing you need to keep in mind when you take that $10,000 out is that come next April 2021, right, when you file your taxes, you are going to owe taxes on that $10,000. Okay. If you have any questions on that, or if you're needing to make a withdrawal for any reason, just call our office before you do it so we can kind of just walk you through and brainstorm and see what possibly would be the best way for you to take that withdrawal if you need to. But the good part is you have the ability to, and they're not at least penalizing you to access your own money. Let's go to questions we're getting. One of the big questions that we're getting is, should I stop or reduce making contributions to my 401k or retirement plan until the market starts going up again? Okay, and this question really hit a peak a couple weeks ago when the market was just plunging until right before we had this 27, 28, 29%, depending on where today ends up, rebound in the Dow. So the answer to that is actually most likely no. Now, why would the answer be most likely no? The reason is that I typically would say absolutely keep contributing, right? But the most likely no is, let's say you're in a situation where you do not have any kind of emergency fund, where you were working, as an example, you were working at Toyota, but maybe you were a contractor there and they've shut everything down, and maybe your income has been impacted, and maybe you were putting things into a retirement account for yourself, but because you felt pretty secure in the fact of Toyota staying open for business, you never thought, well, they'd shut down for a month. And so suddenly your income is being impacted and you do not have enough of an emergency fund. In that situation, it might make sense for you to actually lower the level of contributions or stop the level of contributions you're putting into your retirement account and build up that emergency fund. But that's just a very situational thing, only if you don't have an emergency fund. If you do have an emergency fund and you're okay for the next, 6, 8, 12, 16 weeks, I by all means would continue making contributions to your 401k and your retirement plan. And if you are in a situation where you are not scared of losing your job, right? You probably do have a little extra income because none of us are going out except for groceries, right? Or couldn't believe the dry cleaning was still open. I'm like, who the freak is dry cleaning still when we're all in our homes? But that aside, yeah, essential services. I want a haircut. That's what I want. But the point is if you have a little extra money, just think of increasing maybe your contribution by just even like $100 a month, $100 a pay period, 1% of your pay, whatever makes sense to you. And one thing I want to touch on that is the concept of, everyone hears when you read the news or you see all the articles or the headlines come out, or you turn on CNBC, which by the way, there's my TV. CNBC is never on, whether I'm here or whether I'm at the office, because to me, that is just cannon fodder. They just want to make a lot of noise and do a lot of damage to our psyches, freaking us out about gyrations that they're trying to explain, but that really none of the talking heads on TV know anymore what's going on than anybody else. It's all a guess. So, you know, hindsight's always 20/20, but at the time it's happening, it's a complete guess. So the thought being, when the markets are gyrating, if they gyrate down, or like we've had since, you know, February, right? We've had this just drop in the markets. At one point, it was a 30% drop, right? That means that the next day, like if you had a paycheck come out and they took out your 401k money and they bought into the market, suddenly everything they're buying is approximately 30% cheaper than just where it was a month ago. Okay. And what's funny about this is the financial business is the only business that if the markets drop and your account, because you log in and look at it, is worth less, the natural thing people think doing is, let's not put any more money in. It's crazy. It's like going on a car lot and being like, well, the car is 30% less than you looked at it, Mr. Smith, last month. And I would be like, well, I don't know about that car. If it dropped 30% in a month, you know, I mean, think about how ridiculous that is. You jump over that and be like, yay, I got a car 30% off. So the market's the same way. When it's down and you're putting money in, you're buying at a discount, right? No difference in going into a store and your favorite shirt, instead of it being $100 for one shirt, it's $100 for 5, you know? And that's what's going on in the market right now. So when you put that money in, you're buying at a discount, you're getting a better cost basis, or just think of it as you're getting more for your money, okay? Now, the other thing I want to mention is this. The idea that everybody wants the market in the retirement plans to go up 6, 7, 8% every single year, right? Just nice and steady, okay? And that's what all these, you know, retirement calculation plans, Monte Carlo plans are out there. That's what they calculate, is just steady growth. But the market never just goes in a perfect line. It goes all over the place, okay? So the thing to think about, though, is when do you want the market to actually double? Do you want the market to double when you have $1,000 in it, and then your $1,000 becomes $2,000? Is that life-changing? I would say for the majority of you listening, no. Or let's say the market doesn't go anywhere for a long time, for let's just say 10 years. And I'm not saying that's my thought, but just as an example. And let's just say over the next 10 years, you save $500,000 and you're just starting to save today. And then suddenly 10 years from now, it doubles. Well, now suddenly your 500,000 is worth $1 million. Feel a little better? Yeah. A little more life-changing? Yeah. Than that 2,000, right? But then what happens? The magic of compounding. 5 years later, suddenly we're in the craziest bull market, and the bull market doubles again, right? So suddenly, over, let's say, a 20-year period, it goes 10 years nothing, and then 5 years doubles, and then 5 years doubles, and suddenly your 500,000 you were able to save is suddenly worth 2 million. Well, now you are actually indeed a multi-millionaire. Life-changing? Yeah, absolutely. A lot more than $2,000. Okay. So the idea is the psyche I want all of you to have and all of you to take away from this today is, yeah, nobody likes the market gyrating. Nobody likes the market going up or down. But the thought to have is this: you really don't want the market to go up at all until you have a significant amount of money in there. Okay. And then once you have that significant amount of money, you want it to really go up. Okay. So that's the long side of this. So if you're within a few years of retirement or you are retired, it's a whole different strategy. We're trying to make sure your money is secure, right? But at the same time, if you're young and you're saving and you've just started saving, or even if you're in your 40s and you're like, even if I have early retirement, I'm going to retire 60 or 65, right? You've still got a long, long pathway in front of you. And that money that you're putting in now is going to make a huge difference. So enough said on that. So the other question that we had is, what should I do with my money that I didn't spend on my spring break trip, my trip to visit my family at Easter, or you can fill in the blank. I mean, I had every possible trip in the world canceled. I mean, didn't get to give my sister a hug in England, didn't get to go to Ireland over spring break, didn't get to participate with Keeneland. Guess that Keeneland tailgate, next weekend? It's probably not happening. Unless Andy changes his mind. But point is, all of our plans have changed. So what do we do with that extra money? Well, there's a few different ideas. One of the ideas could be a great time to consider funding any of these things. It could be your grandkids or your kids' education accounts, depending on your age. Or if you don't have a 529 education account, that's something that you could follow up with us and we could talk with you about how to fund. Okay. If you haven't contributed to your IRAs, your Roths for 2019 tax year, remember you have until July 15th to get that done, but you can still make those contributions, or we are in 2020, folks. So you could still prematurely, before you have to, fund your 2020 IRA or Roth IRA contributions right now. Well, the markets are significantly less than where they were just a few weeks ago. Maybe when you're sitting at home, right, in the quiet of your home, and you're thinking, Dave, I just thought of a new goal. Okay, great. We're excited. Let us know. Shoot me an email, give me a call, let Alex, Kirk, any of the other staff know what that new goal is. But let's put a plan in place for it. Let's figure out economically, what do we need to do, right, financially, to get you to that place that you can afford that new goal and realize it. And maybe it may be as simple as something like, I didn't go on spring break with the kids to Disney or wherever, but that $7,000, I have no idea how much it is now. It's $1 bazillion to go to Disney for 3 or 4 days, right? Much less a week. But whatever that money is I was going to spend, I actually want to put it towards a down payment on maybe a lake house, or maybe on a rental home, or maybe on an IRA or Roth IRA, or I want to start a college fund. Or maybe we don't have kids, but my brother or sister do, and we'd love to help them out because we're just so much more blessed than where they are in life. And so, we'd like to help out, our niece and nephew. So whatever it might be, whatever that next goal is, let us know what it is, and we'll figure out how you can financially fund it. And then the last thing, of course, is you already have portfolios. So, and I don't have to tell you like up or down, they're all over the place. But the thing is there's nothing wrong with, again, because things are at a discount, taking some money and adding even a few extra $1,000s to your portfolios. That can make a huge difference over the long run. Now, the next question that we have is, when the markets are down, is it a good time to convert IRAs into Roth IRAs? I know everybody's going to wonder, what is in Dave's cup? That is for me to know and for you to guess about. Okay, so the thought is it a good idea to convert IRAs into Roth IRAs? Now, I don't know if many of you remember this, but back in 2010, after the last 2008, 2009 slide, we bottomed middle of March 2009. In 2010, the government came out and said, hey, if you want to convert money from IRAs to Roth IRAs, we're actually going to give you a special way to pay your taxes. You're not going to have to pay all your taxes immediately upon conversion. Now, they haven't done that this time, and I don't know if they will. Maybe they will come back and do that to encourage people to convert, because, and my thought is they probably will. That's just me guessing. And the reason I said is because if you convert from an IRA to a Roth IRA, the government immediately gets more tax revenue. And Lord knows, we're going to need a lot of tax revenue after all these checks have been written. And the market recovers and the economy recovers and we get to leave our homes again. So the thought is when your portfolio or your IRA has fallen and it's worth less than it was 6 weeks ago, is it a good time to convert? And the answer is yes, it is a good time to convert, but there's some parameters around that. Now, what are the parameters? Well, let's say that you're a retiree, okay? And so if you're a retiree and you're actively using your IRA for just retirement income day to day, and you think that the money that you're taking out of that IRA, you most likely will exhaust that IRA through the rest of your lifetime and not pass anything on, then for you, I wouldn't convert because you're just going to use up that IRA fund. Now, what if we take that same retiree though, and perhaps you were one of the lucky few up until a few years ago, like in the last 10 years, that you still got a retirement pension from the employer you worked for 30, 35 years, a pension and a gold watch, right? And a goodbye party. And so between that pension and the Social Security you and your spouse are taking, you really don't need the income from the IRA for just lifestyle expenses. And so you're one of those people every year that takes that money and just pays the taxes on it and puts it into a non-qualified fund or something like that. Well, for you, as long as you have the money and the means to be able to pay that tax that's going to be due as of the current law next April, right? As long as you have the money set aside to pay the tax, I think it'd be a perfect time to think about converting that IRA to a Roth IRA, because if it's money that you're going to pass on to your children, right? And your children are, we'll just call it mildly successful. And by that, I mean, they're earning more than $30,000 a year. Okay. And let's say they're married and their household income for them and their spouse is, let's just say $100,000 or more a year. If that's the case, they're most likely going to be in a higher tax bracket over the rest of their working years than you are as a retiree. So it's not a bad idea to think about doing that. Now, the question becomes, and this is the depends, the question becomes, and what we're looking at here is a slide that says married, filing jointly. So these are the tax rates that are out there. This is our federal tax rates. There's 7 tax buckets. So if you look at that line of the top 7 tax buckets, I'm going to show you how a Roth IRA conversion, an IRA to Roth IRA conversion would actually work. Okay. So in this first line, what we can see is, let's say the income that you're taking on an annual basis and you filled the 10% bucket, which is income of $0 to $19,750, right? The 12% bucket is income of $19,751 to $80,000 and change. And then on the 22% bucket, this is just money you're taking from pension, Social Security, just life, right? The bucket, let's say your maximum taxes that you're taking out right now for life are maybe like $100,000, right? So the bucket of 22%, if you look at the very bottom bucket, you can see that bucket goes all the way up to $171,000, okay? If your household income is, for example, $100,000, just for this example, then when you go and you convert an IRA to a Roth, let's say that you converted $71,000, right? And a little bit of change, but $71,000 for this illustration, from an IRA to a Roth. When you convert that, the federal tax that you're going to owe on that conversion, because it's in, as you can see, that little garden can, right, with water filling up the 22% bracket, they're going to charge you 22% federal tax on that conversion. So the thought simply is that you could convert up to $71,000 and not go past into the 24% bucket. Now, why is that important? There's really not a whole lot of difference if you look at those numbers between the 22 and the 24% bucket. But let's say your income, is actually, you're still working and you're not a retiree, right? And let's say your income is closer to that 171,000 already, or 250,000. Let's just say it's 250,000. So your bucket then would be the 24% bucket. But at 250,000, you could still put, right, an additional $76,000, and convert from an IRA to a Roth IRA, because when you convert, it's treated as ordinary income. It's treated just like you got a paycheck. There's no, secret magic sauce, nothing. It's just the government looks like it as, well, you already deferred it to put it in the IRA. You haven't paid taxes on it. So when you convert it from the IRA to the Roth, we simply want our tax money. And how do they figure out how much money you pay them? They figure it out by looking at the bucket there and just saying, well, where do you fall in that bucket? Okay. So the thought is if you're younger and regardless of your income, and and this is an example of married, we also have a slide for singles. I'll flash that up there. But regardless of, here's the single slide, regardless of where your income falls, the thought is if you think that you will not use all of that IRA money, right, for retiree, it's not a bad idea to consider converting to a Roth, so that when your kids get the money, they won't have to pay tax on it, and they'll have tax-free money because you've already paid that money. Now, what if you're younger and perhaps maybe you're like a professor, in higher education. Because we see a lot of these or a teacher in the school system, and most of your money is in IRAs or in 403Bs or 457 or 401Ks, right? These types of accounts. If your money's in these types of accounts and most of your savings also has been in IRAs, it may not be a bad idea to try to convert some money while the market's down to a Roth IRA. And again, why? All we're trying to do is use these tax buckets efficiently, but also if you just think of it from a standpoint of when you get closer to retirement, if you have some money that's taxable that you need to pay tax on, and some money that's tax deferred, right? And some money that's tax free, then you're going to have options and choices as you start to take your retirement income and write yourself a paycheck back, right? To be able to retire, just a cash flow. You're going to have more options if you have different buckets that your money's in. So if you have any questions on that, I don't want to belabor the point, but just give us a ring, let us know. All right. I love this one. Am I going to lose all my money? No. Fun story on this, just to break it up. Everybody stretch a little bit. Back in August 1st of 2005, Alex and I founded Family Financial Partners. So this August 1st, we are celebrating 15 years in business, and we have planned to have a celebratory party. We'll see if the government allows us to have parties of 10 or more people, but that's all on hold right now. But we'll be celebrating 15 years. However, this thing called a financial crisis happened in 2008. It started with everyone from like gypsies being given they were making like less than $30,000 a year, $1 million mortgages, interest only out in California. Just crazy things were going on at the time. And that ended up becoming a financial crisis. And as that bled across into the financial markets and then drug our economy down, there was a point in 2009 where I remember the NASDAQ, and many of you will recall this just from the last few days, was actually down to a level that it was down like 5% that day, but it was down 600 or 700 points. And at that point, the NASDAQ was, I want to say it was just down into the, basically to the point of, I did the math on it, and I walked into Alex's office and I said, hey, Alex, I said, that was a brutal day in the markets, wasn't it? And I'm not sure if I said it or he said it. I have a feeling he said it, but he said, if we have like 12 more days like that, we don't have to worry about it. And I was like, what do you mean you don't have to worry about it? And he goes, because it will be zero. And I was like, oh, well, that actually ended up being very close to the market bottom. So the point is that the last few weeks, right, you've seen a lot of probably reports in the news with the markets up 5% or down 5% or all over, God's green earth, 3, 4, 5, 6, 7, 8%. It's all over the place. What that is the market is trying to figure out, where the bottom is. And are we at the bottom? I have no idea. Nobody has any idea. But usually when we see those giant volatility swings, it means that buyers and sellers, and in this case, a lot of computer programs and algorithms that are running out there, as well as pension funds and sovereign wealth funds, as we've seen many of those make buys over the last few weeks, they're trying to figure out where fair value is. And so the thought is that, no, you're not going to lose all your money, but I can tell you that I know for many of you, it has been a trying time. So if you are looking at an account that you're really concerned about and you haven't talked to us for a while, because believe it or not, there's a few of you out there that for some reason do not return our phone calls and only call us like right at the market bottom. But if you're looking at an account and you're concerned about it, please just pick up the phone and give us a ring, and let's take a look at it with you and talk about it and just see if there's any changes that we do need to make. Because I know a lot of you do have accounts that are not just held with us. They're things that are self-managed or things, but during these times, you're like, I'd like a second opinion on what I'm doing. Or there's maybe a few of you on this call that don't work with us. And you're like, well, I've been in this strategy and it worked great for a decade. And then I just went back to 2016 suddenly in my portfolio. Well, there's no need for that to occur. But now that it has occurred, the question is, how do we get you back to February of 2020? So if you want to talk, just give us a ring. So what is FFP doing with my accounts? And I wrote some notes, so I'm going to glance at them real quick, just to make sure I cover all my spots here. Okay. Want to make sure I get these right for compliance purposes. In 2019, January 2019 until really like even February and early March of this year, we've been having a conversation with every single one of our clients about the risk tolerance and what they think it should be versus what it is. And a big part of that conversation, every year, every financial advisor should be having that conversation ongoing with their clients. But really what precipitated the 2019 and early 20 conversations was that little blip, and many of you have even forgot that it happened, that happened in the fourth quarter of 2018, where from October 1st, where the market was here, by December 24th, and I remember it because it was the most miserable Christmas Eve in the Smyth household, the market was here. And the reason was the Federal Reserve was raising rates, and everyone thought the Federal Reserve was going to kill the market and kill the bull market by raising rates. And so the market sold off as basically a sign of protest. And then what happened is right after Christmas, 24th, 25th, the Fed came out and said, hey, we're actually not going to raise rates anymore. We may cut rates. And everybody went, yay, and the markets was just, okay? And it literally looked like a V, okay? And so for most of 2019, except for a few little hiccups here and there, the market pretty much went up. So while it was going up, we had a conversation with everyone about the risk tolerance. And we encouraged, especially retirees who are, you know, you just can't take as much volatility as you become a retiree unless you're just simply passing the money on for the kids. And then in that case, we try to manage the money for your 40, 50, 60-year-old children, not for the 70, 80-year-old. If you're not going to use the money and just pass it on, you might as well manage it for the next generation. But for those of you that do need the income and or do not have a high risk tolerance, you have a very low risk tolerance, we did encourage you to take some off and to just kind of roll back. So for a lot of people in early 2020, not knowing anything about coronavirus, because unfortunately I do not speak Chinese, I did not read the newspapers over there. I apologize. I've learned something from this that going forward, I will learn Mandarin and I will read the Chinese Times every morning. That's what, you know, coming out of this captivity, that's my one improvement goal. So you guys can hold me to that. Let me know, ask me how that's going in a couple months. But the point was we had a lot of people in January, February, we just rolled back the gains from 2019 and just said, let's just take a little bit off and see. We had no idea that this was going to develop. Nobody did. This was a crazy black swan pandemic, right? That is really spooky. But for those of you, there were also those of you that said, well, Dave, the market's like a roller coaster. What goes up also comes down, also goes back up. And I'm just, you know, invested in America and that America's great and we continue to innovate. So I'm going to ride it up and down. And I know a number of people are kind of being tested on this because this time is different, as none of us have ever been in a situation where everybody's businesses pretty much shut down, you know, from a day-to-day normal operations. I mean, our business continues to go because we can do business online, but a lot of, you know, if you're in the restaurant business, it's shut down. If you have a nail salon, it's shut down. If you're spa services, it's shut down. If you're doing any kind of elective medical procedures, that's shut down. You know, even realtors are having problems with, you know, it's just slowing the way houses can be shown where nobody can touch anything in the house, you know, and they have to wear their mask and it's crazy. So I know some of you are being tested for I'll just ride the roller coaster in the pandemic because we never have experienced a pandemic like this in our lives. So, but that said, what we are doing within all this is we are constantly looking at all of your portfolios and we're rebalancing them. And many of you who work with us through our InvestNet accounts, which is our advisory accounts, where we have the ability basically to manage your money within a box that you tell us, here's my risk profile, and you can manage the money in the box and do anything within that box. But if you want to go outside that box, you have to ask me, Dave. So for those investment accounts, you've probably seen paper or electronic trade notifications and activity come through. Just as a reminder, there's no additional cost from a ticket charge or anything by us doing those kinds of activities, but we are actively rebalancing accounts. For the sake of our audience today, I'm not going to go into the specifics, but do know that whether it's tomorrow or Monday, I will be sending out a quarterly note to all of our clients that have InvestNet accounts, and I'm actively writing that, not right now, but I will be doing that this afternoon as I just got in all the information from the last quarter to kind of recap and regurgitate for you what we're doing. And I think you'll be pleased as you see what we're doing. Part of that also is reminding everyone to take a look at the retirement accounts, their 401ks, the work 403bs. If you need us to take a look at your overall financial picture, right, and just see if there's anything that's kind of out of whack. What we typically see is, like, if you had a 50-50 stock and bond portfolio, just to be generic, and if the market has fallen, you know, it's still down 15% or so. So if it's fallen here, the bonds, they may have not gone up depending on what kind of bonds you have, but they haven't fallen like the market. And so your allocation, instead of being 50-50, maybe something like, you know, 55-45, or it may even be 60-40. And so a simple idea in rebalancing is you can even just go into your retirement account if you know what your risk tolerance is, and you can just rebalance it to 50-50. Within the overall broader picture of your portfolio, we're looking at all of your individual accounts that you have with us, and we're making those rebalances. And we're not doing those today. We're actually doing those a few weeks ago. When the markets were low, and we actually were very pleased that we were able to be as proactive as we were at the right, what looks like at this point, a temporary bottom in the market. Whether it becomes a permanent bottom, 2020 vision when we look back, but we were able to reallocate your portfolios at a very good place. So that said, to my knowledge, we have not had a single emergency sale in any accounts due to COVID-19. I haven't had a single client come in and be like, oh my gosh, I'm freaking out, I have to do this. Now, I have had a couple people that are business owners where they've said, I need to raise a little bit extra money just because I don't know what's going to happen to my business payroll, and I don't want to fire my staff, and I've applied for payroll protection, you know, with the CARE Act, but you know, I just want to have a little cushion. So we've worked with those people. You know, I always joke in every market downturn that there always has to be one person that does sell at the absolute bottom, and because there was one person in 2009. And we'll see if it was the absolute bottom, but there was actually one person back in, you know, late March that called in and was like, enough, take me out. And everybody else to that point, I'd be able to talk off the ledge, right? And but there was one person that did completely sell. But I kind of equate it from the old proverbial, like when I first started in the business 24 years ago, they said, well, when there's sometimes when trades are not going well or the market's not going well, you kind of have to take one of the positions that's not working for you and just offer it to the volcano, kind of like a maiden in the volcano, a sacrifice, right? So I believe that there's one person that sells, it's like the sacrifice for all of us. So to that person that did, thank you, because the market has gone up 25, 26, 27, maybe more, depending on where today ends from that level. But I don't say that like in a, you know, joking way. I mean, it's really sad that it occurred, but at the same time, you do see that kind of panic, typically kind of at market lows. You don't see the same at market highs, where people are, you know, trying to sell. It's at market highs, everybody is trying to buy. And what's interesting is we did have a lot of people in January and February that were investing for the very first time. Didn't even think about it at the time, but you look back and you go, oh, go figure. So for those people, you know, they're a little bit more nervous because they got in at the exact top. But we're working with them throughout that and figuring out a strategy with them. And the good part is dollar cost averaging works for everyone. So the last big question that I had is, are you guys still taking referrals? And the answer is absolutely. You know, a lot of people think that just because we're all at home, you know, that we're not able to necessarily fully function. Well, I agree. I can't sign everything real time. You know, I have to go into the office to do it and make a special trip and quarantine, right? Wear a mask. But the reality is we do have a little extra time because in-office meetings don't take nearly the same amount of time as just conference calls and Zoom meetings and those types of things. So, you know, if you do have somebody that you're talking to, I know a lot of you are doing different calls or social happy hours or things of that nature, or, you know, remote Easter celebrations. If you are talking to someone and they ask you a financial question and you think you know the answer, because I know majority of our clients are very educated people and they're super good at what they do for a living, and most of them are actually super good at understanding what we help them with financially. And so a lot of you are actually the proverbial experts in your relative circle of friends when it comes to your finances, because you really are doing the right things. But if someone asks you a question that you're like, that's probably going to elicit several follow-up questions, and I'm not necessarily sure I want to know everything about their situation, right? Or go down that level in the friendship. Feel free just to you know, provide them with, you know, Alex's or Kirk's or my name and number, the office name and number. We'll hook them up with someone. Even if it's just helping educate them, answering their questions, and just making sure they make good choices through this and don't make big mistakes. You know, there's value there. And I know for a lot of you parents, you're going to probably be talking to your kids during this Easter holiday and Easter weekend, even if it's just remotely. And there may be things that come up that you're like, I can't believe you're doing that. But I, at the same time, don't want to tell you what to do because I'm trying to go past the parenting stage now because you've moved out. And, you know, we just really want to participate as grandparents in your life with your children. And just say, hey, why don't you talk to my guy? And just have them ask us that question, and we'll give them, you know, the square answer, and we'll help them out. So I just mentioned that you know, we are here. I honestly would love it if you like gave me 100 people to talk to, because I am so freaking bored to death in here. I feel like I'm in a prison, you know. Now it's not really that bad, but it is. Now let's talk about the market. So what we decided to do is I've kind of got to give you a fair, balanced view of the pros for buying and the cons for buying, right? Of like what could continue to go on. And so the biggest thing just generally is the sell-off that we had, that 30% down was deep and it was swift. And, you know, relative to previous market crashes, I'm sure most of you are excited to hear that it was in the top 5, right? Yeah, not one of those things to celebrate. So when you see that kind of selling, usually that's kind of panic selling, that just straight down thing in the market. And then, you know, we've kind of been going like back and forth where as the market's recovered, it's given some people who needed to get out the ability to get out. And then as it dipped again, it gave people that are dip buyers, that's just a relative term for market stuff. The dip buyers came in and bought what they thought was value, and now we're back up again, and we'll see how today closes. But when we typically get those kinds of sell-offs, they do create, they tend to create value. The next thing is that unlike in 2008, you know, because that's the thing that's the last event in a lot of investors' minds, especially my, call them mature clients, right? That have been investing for a while, that they remember that was like the big, just kind of shot to the gut. And they all remember that it did take a long time to recover from. Well, unlike 2008, the financial system actually seems to be fairly intact. And what I mean by that is you do not have the situation occurring with the banks that we had in '08, where all of the banks had to be bailed out because they had all just made ridiculous loans. Between the banks and the hedge funds, they had created all kinds of different mortgage loans, different types of paper and things that people could invest in. And it was a complete house of cards, and it collapsed. And so the Federal Reserve had to go in and they had to bail out the banks. And so in that situation, the problem was and we had, we had some of the brokerage companies go out of business. I mean, it was just crazy, but unlike 2008, our financial system seems intact because they've been doing ever since 2008, they've been doing regular tests, starting, I think it was 2010 forward, on the banks to make sure, where they were at for liquidity and for loans and quality of portfolios and all of this. So, the banks really aren't extended, okay? So that's a pro. We shouldn't really have potentially that long just recovery time that we had in '08 because of all the pressure on the banks. Now, the other thing that's happening is current rates right now with the Fed, announcing they were taking the targeted rate to 0 to 0.25, quarter of a percent, right? And a lot of people ask me, like, why don't they just take it to 0? Well, they can't just take it to 0. Well, they could, but they really can't, because for all of us that invest in money markets, right, that money market has, even at a 0.25% federal funds rate, a very, very small yield, okay? If they took it to 0, potentially you'd have all your money markets go out of business because money markets have a cost. And that would be a real crisis. So that's why when they cut to a quarter, that's basically the equivalent, in my mind, of 0. But with rates near 0, that makes the S&P 500 dividend yield very attractive, right? It's in that 2.25%, 2.3% range. And when you compare that to for example, a 10-year bond at 1, depending on the day, right? That's fairly attractive moving forward. So that could be something that would attract people to the market. In addition, all of the data until just the last couple days, right, assumed that we were all going to die, that humanity was going to be wiped out, that we're going to have one of those, sci-fi worlds with all these, old rustic buildings and everyone walking around with goggles and masks and fur skins and, souped up really cool guns, like Mad Max style. That would have been cool. But the point is the data was assuming we're all going to die and this whole world's going to change and we're never going to go back out again. And what we're seeing the last couple of days is, we may have actually been wrong. We're not going to see, 100 to 240,000 people die. It's going to be a lot less. And so the markets have been going up because the data has been assuming that the worst is going to happen. And so if the worst doesn't happen, the COVID news gets a little bit better, the uncertainty in the markets goes away, that could be a positive. And then the other thing, and this is slightly dated, I've got a little new information on this, only just because there was an announcement this morning, but we did have the CARE Act that provided $2 trillion, that's a lot of zeros, $2 trillion, that could be a good home project for the kids, trying to keep them busy, be like, make $1 trillion on paper. But keep them busy for a while. You also know how smart your kids are, right? If they start cutting up little strips and counting piles of 100, they got a long life ahead of them. But the $2 trillion in stimulus, we've never seen that in a market. We have absolutely no idea. It's akin to taking a fire, maybe a smoldering campfire, because the economy is not doing that well with it all being shut down, right? Clearly, and unemployment being crazy and whatnot. But with the smoldering fire, you take lighter fluid and you dump the lighter fluid on, that fire is going to expand some way, whether it's a brief explosion, right, that burns the trees above, and the limbs and things hanging out, or it may just restart that campfire and the wet wood or whatnot that's there is suddenly engulfed in fire. So there's no way, though, that when you put $2 trillion into an economic system, that it's not going to have a big impact. And so I think that, that money is going to take a little while to hit, right? We all know that's not immediate. So it's going to take a little while to hit the system. But just like the Fed cutting rates, when they put $2 trillion throughout the system to work, that money is going to turn, and that money is going to help keep these businesses afloat, and that's going to help people make the bills, and that's going to help just the economy in general, and that money will circulate. Maybe not as much as a dollar under times of not as much stress, but it will still circulate. And so some of that money obviously is going to go to help with healthcare and with testing and whatnot. And so, the thought is everyone's kind of debating when they open back up the market, but, even if they open up society and say, let's leave our homes and let's go out, we still have the same problem, right? We still have the same problem, which is we can still catch this thing. Now, I'm not going to debate, what the odds of catching it are and this, that. I have asthma, so I'm being extra careful just because I've seen what it does to people with breathing problems, right? I don't need that. But at the same time, when we all leave our homes and go back out, we still don't know how to stop it. We still know that a certain part of society is at a higher risk than others. And even the younger ones of us that maybe it doesn't kill because we're in better shape or we don't have asthma. Thanks, genetics. They could still be asymmetric and they could still be carriers, and you could still get your grandparents and your older friends in your neighborhoods sick. So there is a real problem there. So while the $2 trillion will hopefully go to helping test people, whether it's temperature monitoring, whether it's, I've heard people say we want to put bracelets on people or identifiers on people, or let's sign of the beast chip everybody so we know who has it, who doesn't have it, who's cured of it. I don't know what the solution is, but until there's actually a vaccine, this economy is not going to just fire back up and function normally. But at the same time, just like that campfire that's smoldering, you can get a pretty big flame with $2 trillion. So, cons for buying. Now, the problem here that we have is, and I would love for this not to be the case, but the sell-off that happened actually happened from nosebleed sections. So from just nosebleed, if you're up in the nosebleed, have you ever gone to like a UK basketball game and you sat at the very top and you like look down, the fireworks even go off below you? That's where the market was. And so even though it's fallen, the market from just a valuation standpoint is not actually cheap. In fact, capitalization to GDP was, prior to the sell-off, was at a 1999-2000 bubble high. So unlike the 2008 correction, we don't have stocks that are just like screaming, oh my gosh, this is dirt cheap, you got to buy everything. For the whole market, it's just not there yet. The other thing that we have is it's going to be really tough to estimate today's corporate earnings. You've probably seen it where, Apple's come out and I think yesterday or this morning, Starbucks came out and said, hey, our earnings aren't going to be, they're going to be this. They're going to be probably half of what they were previous year. And we're basically pulling all financial guidance for the rest of 2020. And you're going to hear that from, it's not just Starbucks. You're going to hear that from, you heard that from Costco. You're going to hear that from, we heard it from Pinterest. We'll hear it from Microsoft. We've heard it from PayPal. We've heard it from, we will eventually, I think, hear it from Facebook and Google and all those big companies, right? Because nobody has any idea what this economic bounce is going to look like. There's people that debate it all the time. Are we going to have that October, kind of V bounce that we had in October 2018? Or is it going to be more like 2008 financial, where if you want to think of it like a letter, we had the L, okay, just kind of came down and just kind of went like this and went like this, right? But just L for a while, and then eventually it came back up. Or there's other people that are debating maybe what we'll have is actually more like a U, where we've come down and we go back up, but it just takes a little bit more time than the V. The problem with all of that is there's so many people trying to figure out what these corporate earnings are going to be. And if none of the corporate companies are willing to give guidance going forward, then to go back to point number one, how do we know what the market's worth? We really don't. So the uncertainty of, the data assuming the worst for COVID, right? And as that gets better, right? And that makes people want to buy. At the same time, it's like, well, I'm not really sure if what I'm buying is of good value. So until we can lock that in a little bit more, I would expect for there still to remain a lot of volatility in the market. The other thing that, this changed a little bit today, but not a whole lot, is, the previously in 2008, the financial issues were with the banks. And now the banks are good. But all these large corporate companies, right, have taken on all kinds of debt and they bought back their stock, which helps their stock price usually go up over time and or supports it from the day-to-day volatility we've been seeing lately. And of all things, there's even been political things going around of saying that any of these companies that get some kind of bailout, right, shouldn't be buying back shares, which I totally get that, because why would you buy back your shares and enrich your executives with your with the money that we all just loaned that company? But at the same time, for other companies that don't need loans, they've been chastised for not paying bigger dividends or not and just for buying back their stock when they could just pay bigger dividends to people and help people out with more cash flow. And the reality is that what a lot of people don't realize is these corporate companies out there are the ones that actually provide a lot of the economic stability in the markets on a day-to-day basis through their stock buyback programs. And so what we've been seeing the last few weeks is we've been seeing those companies not doing their stock buyback programs like they were for the last few years. And that's what you get. You get this crazy volatility. So if these companies and these corporate entities are unable to open for business and cannot go back in and do not have the ability to buy back their stock, then prices could be more volatile, continue to be that way. But also what could happen is that if they can't get debt issued, then you could have more corporate defaults. And I'm not just speaking about like a big company defaulting. I'm also taking it all the way down to individual balance sheets of the consumer. If you're hearing a lot of people saying, well, I under this new mortgage program, I may not have to pay my mortgage lender for up to a year if I just claim, COVID-19 difficulties and whatnot, which is great if you don't have the money to pay it. But that's your only option, right? But at the same time, that payment doesn't go away. That's just added to your loan. And you're either going to have to pay it all back in one big chunk or they re-amortize your loan. So it's not like you're getting free money, though. You still are on the hook for making your mortgage payment. But I think that could put more people into potentially, financial default if they can't make their bills. And that's something that is a little bit different this time around. So that's something I'm worried about. Just if this, they're saying, we all go back to work here in the next, 4 weeks, 6 weeks, who knows when, right? But whenever we do, let's just assume society opens up and everything's great. Well, what happens if it continues? What happens if it comes back in November and we all have to go back in again? And we, shut down everything again, or we shut down everything to even a partial degree of what it was. Well, that first aftershock to every company and every consumer, right? Most people want to maybe rebuild their emergency funds after that first shock. And if a second shock happens and people don't have those emergency funds, that's where we could really get into some issues. And the big thing is that, we're just starting to see the unemployment numbers. And of course, the numbers I had prepared for this were based on the study done on March 14th. And then we just had new numbers come out today. But just the ones that came out last week, last Thursday, was the largest jump in unemployment, okay, that has occurred in the country since January 1st, 1975. Now that's a big jump, and that was according to TD Economics. And then of course the jump today was even bigger. I don't have those exact numbers in front of me, but they were giant. And most likely next week will even be bigger. And the reason they were bigger this week and most likely next week is the March 14th numbers that we looked at last week that were reported, that survey was done before, all restaurants were closed and salons and, you can't get your hair cut and gyms and just all businesses in general were shut down. And so as soon as those businesses shut down, suddenly a lot of people were unemployed, especially from the restaurant industry. That hit everybody really, really hard quick. So we're going to see those numbers, most likely continue to expand for quite some time. And we've never had a situation where, we've seen such a rapid increase in unemployment. And so we really don't know how that plays out in the cards. Now, again, depending on the type of recovery, if we have a V recovery, right, then everybody goes back to work and everybody's hired and everything's fine. If we have an L recovery, that's a whole nother scenario, right? Because unemployment stays there for a long time. And even though Costco and Walmart and Kroger's and Amazon have announced they're hiring all kinds of things, there's all kinds of jobs. If you want a job, testing for COVID-19, be my guest. My hat's off to you. Thank you, all the medical providers that are, but that's a tough place to go for your next job if you're unemployed right now, on that front line, for $12 an hour. But if you have to go that route, there are going to be some jobs that are there, but they're not going to be the same kind of jobs and the same quality of jobs that were lost, most likely. So that is a real issue that we have not really seen in the economy. Now, that said, there's been so many different stimulus packages, and in fact, we're supposed to see our Senate get back together and vote on additional stimulus packages. That's kind of pending. And then this morning, we even had the Federal Reserve come out and they announced a new $2.3 trillion program where basically they can backstop all corporate debt. So what they're doing is they're basically saying for the foreseeable future, if you have a corporate entity and you need to issue some debt, worst case, we'll basically guarantee that debt. Now they can't do that forever, obviously, but $2.3 trillion is mind blowing on top of all this. It's like dumping even another thing of fuel on the fire. That should help corporate entities be able to raise the money to then keep people in that corporate enterprise employed and therefore put less strain on the corporate entity and hopefully a little less strain on the unemployment numbers. So that's just something to look out for. And then lastly, obviously, none of us have a perfect crystal ball. I know everybody suggests that financial planners and advisors should have that. But, there is a real question of, flattening the curve, right? Even if we do flatten the curve, eventually COVID-19 is going to move through the whole population, right? And until we have some kind of vaccination for it, what does the world look like? And we may never actually go back to that new normal. It may be a Mad Max world that develops over the next few years if we never can find that fix. So, that's the outlier, that's the doomsdayer, that's the, there is no hope. But nobody has a solution yet. So that's why we're all still living cooped up. So the real question is just in all of this, kind of wrap up this concept is you have to understand this isn't just the US's problem. This is the whole world's problem. We're all fighting this together. We're all looking for a solution together. And we're really, if you are buying, you're simply banking on the notion that the whole world has the ability to constantly reinvent the way in which we do things and the way in which and what we have to do in order to continue to grow, regardless of the challenges it faces. So the real question isn't whether things will improve tomorrow, because they most likely won't, right? So, you know, hanging on every bit of news, hoping that the numbers go down or this or that, I just think it's a kind of a useless activity and a waste of your mental capacity. But the question of, will things improve in 3 months, in 6 months, in 9 months, in 12 months, in 18 months, as vaccines are developed and things of this nature? You know, my belief is that, yes, it can improve, and we can, you know, establish a new normal in society for how we deal with these kind of pandemics, because most likely this wasn't the first, right, of our lifetime. There's probably gonna be more, you know. This is just one of those crazy things of the way the world changes. But at the end of the day, there is that Warren Buffett quote that I like to remind people of. And he actually, I believe, said this quote. I could not find the date for it, but I believe he actually said this quote in late 2008. And it was actually said before the market actually bottomed in 2009. So he was a little early to the party when he said this, but his quote was, in the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions, financial panics, oil shocks, sound familiar? A flu epidemic, and the resignation of a disgraced president. Yet, the Dow rose from 66 points to 11,497 points, which is where the market was at back then in 08, having fallen significantly already. It would continue to fall. But his point was, even if you bought that day when Buffett, you know, made that comment, the next decade actually worked out pretty good for you. You know, the next 3 months, 6 months, not so great. But the point is that, you know, there's always going to be challenges that we're facing. And, you know, we're going to, as an economy, work through this. So I just want to take the time just real quick to recap a couple things from our presentation for you, and then we'll wrap it up here. So things to consider, just to remind you of, are, do you have emergency savings, right? If you don't, give us a ring. Let us talk you through some ideas of how to build that up. But just make sure you do have your emergency savings. And if you've had to start to plow into it a little bit, maybe just think about how you could change your bills a little bit, or some of your, what you're doing with your money, to kind of just replenish those emergency savings. If you do have the emergency savings in place, think about increasing that 401k or retirement account savings. Review your goals and fund those goals as able. You know, consider IRA, Roth IRA conversions. And then the last couple are really kind of fun ones. We'd really recommend that try to watch 30 minutes or less of that COVID-19 news daily. You know, just mentally the number one thing is keep yourself in a good mental place, because we will come out of this. But just try to keep yourself mentally strong. And while you're doing that, what I'd recommend you do is, instead of watching that full hour with Andy, just watch the part where, you know, fast forward to the part that he like gives us our number or whatnot, if you need that. But during the first 20 minutes where he's going through all the slides that he always goes through and pick up a book and just read it until he gets to the good stuff, you know? If you could read, one of the goals I've made for myself is just try to read a couple books a week while this stay-at-home lasts. I don't know if I'll get through 2 books a week, but I'm trying to read 2 different types of books. So when one gets really depressing, I can go to the other one that's more like fictional, you know, and then back to a historical one, and back to a fictional or self-improvement or whatever it might be. But I'm just trying to do some things just to keep my brain firing. And then lastly, if you're not a reader, I mean, I know there's a few, we do live in Kentucky, and there's several of us that just cannot read. Let us know at Family Financial Partners. Let our team know what new movies or Netflix series, Amazon, Disney Plus, you know, what are you watching? You know, everyone I think is desperate for content. And one of the things that, like, in my mind, honestly, one of the biggest things that I'm fearful of all of this is, what happens if this goes like 6 or 9 months and Disney can't do any more Disney films and Netflix can't do any more Netflix? What happens then? What are we going to do? You know? But all kidding aside, I do appreciate you tuning in. If we can answer any other questions, I know there's been some other questions we received before this call. We will present them during our next Thursday Thoughts. We have to run them all by compliance just to make sure that we can present them to you. And but we will cover those in our next call. I appreciate your time, and I just wish you, stay safe, enjoy your time with your family, and this too shall pass. We'll talk soon. Thanks.